So a lot of times you see if the algorithm goes negative, okay, I'm going to
look. Patrick MontesDeOca with the Equity Management Academy live trading room, live streaming from Ticket-Tacker platform. We got a real fast market this morning in the gold market, up about $27 here, 1868.30 trading last. And what we have seen here is an increase in volatility unlike anything I have ever seen before. Now, I want to tell you that I've been around for a little while here, and one of the things that I've noticed here over the past, actually since March of last year, and if you go back to some of the videos that I've done and reports that I've written, I've commented about the change in paradigm that occurred back in March of 2020, when the gold market collapsed down to about 1450, and the stock market collapsed as well into 2150 or under 2200, and that was the bottom of this whole new trend that essentially was the transformation from the old economy as we knew it, the physical economy as we knew it, and transformed us into a virtual economy. This was one of the reasons why the gold market went up to 2,086, and it was a $600 move with a blink of an eye. That was just the beginning of things to come. Now, I want to put into perspective here what I've been talking about and what I've been pretty much alerting my traders, my subscribers in my private trading room, that the volatility shifted into a virtual level, or a virtual market, or a virtual economy as of March of last year. The stock market is a very good example of the initial thrust of that volatility, and followed by the metals, gold mining shares. And so 2089 was basically a price that had discounted the economics that the pandemic essentially caused. I want to make sure that we have everybody here listening. Bear with me, please. Okay. And now we're looking at the beginning, basically, of this volatility being shifted and transferred into other sentiment, like the millennials, for example, which recently, as everybody has seen the news about Robinhood limiting trading in some of the stocks that have gone up, 200, 300, 800%, and GameStop and so on. The playing field has changed in regards to technology application against what is so-called some of the biggest hedge funds that essentially have been controlling this market. One of the reasons why we're doing this live show basically is to share that intelligence to all interested individuals that are self-directed traders that want to take advantage of this technology. That's one of the reasons, pretty much, why I'm doing this. Because this is the beginning of a whole new world that is giving you the opportunity, regardless of how big you are as an investor, to be able to take advantage of the market. The old saying was, you had to have a lot of money to make money. Well, technology has leveled that playing field where you saw what happened to GameStop, and all of it was simply a concerted effort of buying. When we talk about the supply and demand, basically we talk about, the stronger, who's buying more and who's selling more, and that's going to reflect on the price. So we go back always to the basic economics. The thing that I'm beginning to see is that the buying demand that essentially is transforming now, creating a new breed of investor, a new market, I think is the transformational point that we've been looking for the gold market and the silver market in particular. So now we have this sentiment out there publishing basically information that are looking for $1,000 silver. This is the same crowd that basically caused these explosive prices, or I would say to break the volatility benchmark as we knew it. We have entered into a whole completely different benchmark in volatility, which is a virtual volatility. We are entering into a virtual economy. We're about to see a virtual currency being issued. We already have pretty much a virtual currency, which is called Bitcoin, in my opinion, that's leading the way to all of these other virtual currencies that are unfolding out of the woodwork. And so you can see the energy transformational period that we're in right now, which are taking place in these markets, from a physical market as we knew it fundamentally to a completely new economy virtually. Now, one of the things that we're looking at here, obviously, in the gold market is the fact that the gold market has not reflected basically the actual economics or the fundamentals that we're dealing with regarding the stimulus, regarding fiscal policies, monetary policies, interest rates. It is not reflecting the value or the ratio of gold to stocks, the gold to debt. These are all major components that are related to the economics of the price of gold. Everything is related economically. And gold is a major benefactor of a weaker or a weak or a falling economic system. It has the dimensions of a safe haven, a risk hedge, and also an economic indicator. Also, it's real money. It's been real money for thousands of years. And so we're finding that volume, that market, that shift that the gold market needed, the attention that the gold market needed or the silver market needed, understanding the consequences of all of these monetary policies, of this economic policies, of this Keynesian economic system that is getting us and moving us from one debt economy and into another freshly baked virtual economy which has no debt. It's the ideal transformation of a reset for the world economy. So when we look back at history, I cannot help to see that gold has been in the monetary system for thousands of years, 5,000, 6,000 years, against this new transformational, incredible virtual world that we're coming into, which in itself is bringing in all this tremendous volatility that is unprecedented. Uncharted waters is what we're dealing with. Now, to me, being around for a little while, this volatility is, I feel like a kid in a candy store, because that's a trader's dream come true to be able to have this kind of volatility. This is where trading in the futures basically becomes or is popular, because fortunes can be made overnight and lost overnight. So as we move forward with this kind of volatility, it's a question of how do we deal with the risk? How do we manage the risk? And obviously what I'm doing here is I'm showing you how I am doing it by using the VCPMI to identify for me mathematical probabilities. You can't make sense of fundamentally what the market is doing. As you can see, when you think about fundamentally, the gold market should be at $5,000 based on all the economics, but it's not. And so you got to trade that market. You got to position yourself in a way that you can hold on to your core belief, your core position, your long-term objective. And regardless of what happens short-term, to trade the short-term gyrations, the short-term anomalies that provide great opportunities. You know, from 2089 to 1864, that's a tremendous range. And depending upon your skills and your profiles, either you're going to sit there and, you know, hold on to your purchase at 2089 and complain that the market, you know, is not doing anything or whatever, or take advantage of the short-term signals and trade against your position. This markets right now are probably in one of the best times that I can remember. And to a certain degree, it feels a little similar to the 70s, when we began to see inflation take off. And the price of gold went up to $800 in 1981. The stock market was trading, the Dow Jones was trading roughly at about $1,000 at the time. Interest rates were roughly at about 15%. Different playing field, but I think the only difference here is the interest rate picture. Where we are right now, basically, are in negative territory as far as interest rates are concerned, or at least the movement on a global basis is to get us down to negative interest rates. Europe has negative interest rates. I believe as a trader, it's impossible for an economy to function with negative interest rates, where you have to pay your bank a percentage of your assets. It's not going to last. And for them to go out and make all these fortunes with your money while you pay them to hold your money. So the difference is that we are at a point where interest rates are negative or going to negative in an economy that's dealing with a pandemic that essentially has collapsed the world economy, our own economy. And there is no light at the end of the tunnel yet in terms of when all of this will be resolved. And therefore, the economic expectations coming back to a normal economy are a little bit ambiguous. So in the meantime, we have this tremendous amount of debt. We have the governments producing incredible amount of new stimulus, new money, printing money out of thin air. They're not concerned with the effects long term. They're not concerned, you know, with the reality that the more money that you print, the more you jeopardize the US dollar as the reserve currency, and therefore it's in a position possibly that over the long term, we're going to see a collapse in the US dollar. I think the money realizes that there is no turning back from here. They can't raise interest rates on this bubble of debt that we're dealing with, which is like, I don't know, $28 trillion at this point, I believe. It's hard to count anymore. It just continues to pile up. And I don't know if the numbers yet have fully taken into account everything that's happening to the present time. So, you know, we're going to be dealing with a $30 trillion debt anytime soon. And if we get interest rates to start to move up in that neighborhood, it's going to put a lot of pressure on the cost of that debt. And so, I think the Feds are in a hard place between a situation that they can't really control, because potentially, as they continue to implode the intrinsic value of the US dollar, the purchasing power of the US dollar, it basically continues to erode and increase the as I say, the value, and increase the possibility that we could see pretty much a deflationary move in the US dollar and move into negative territory. The idea that the US dollar is a safe haven is short term, because it's competing against other weaker currencies. And why the US dollar is holding is because the other currencies are basically weaker than the US dollar. But as we move into printing more money and more money around the globe in every economy, the currencies are set to go to zero, and we're going to see a reset of currencies. And I believe it would be a perfect time, when all currencies go to zero, to bring down that old debt in that currency, you might say, obviously down to zero, which is the idea of devaluing the currencies, and introduce us into this new world economy with a new virtual economy, a new virtual currency, and no debt. I think that's pretty much the idea, the intention. And I think if interest rates begin to go up, there are a couple of possibilities, basically, if you really think about it. If you go back into the 70s, we saw the price of gold go up to $800 from what, 35, or it was about 100 and something dollars right after they basically it went from 35 to about 100, and then Nixon lifted the dollar of the gold standard in 71, and then we saw basically the price of gold went up to about $800. Let me somebody asked a question here about what I think of Dogecoin and mining. This is the virtual economy that I'm talking about. All of these currencies want to be part of this virtual economy. And so therefore, they're coming out of the woodwork. I mean, you name it. And I think you want to be cautious. What you want to do, in my opinion, which is what I'm doing, is you want to take a look at the leader of the parade, which in my opinion, is Bitcoin. I think Ethereum is coming up behind it. But I trade GBTC, which is the grayscale investment trust in Bitcoin. And I trade it. I don't, believe it's money. I don't want to pretty much, take that risk in terms of the liquidity that it offers as much as taking that liquidity and going into the gold market long term. The gold market is completely undervalued, particularly the silver market. So, you know, there are people out there now that are talking about $1,000 gold, silver, excuse me, and $8,000, maybe even $10,000 gold. For the first time, based on what's happening to the world economy and where we are, I believe that it is possible for the markets to reach those levels here. Not only to reach those levels, but to do it in a short period of time. GameStop is going to be the benchmark of volatility. And it has shifted the playing field for Wall Street. All the big hedgers now are the short hedgers, the ones that pound the market. And consequently, we're talking about the short side of silver. I believe that you're looking at one of the biggest short squeezes in the silver market that we have seen in the history of the silver market. And the silver market is poor man's money. Trading, what, at $27.50? We haven't even seen the silver market break the high that we saw back in 1971, which was $50, or even just in 2011. The ratio of producing silver is 8-to-1 to 1 ounce of gold. And I think when you look at the ratio, the relationship of the gold and silver ratio, just to take a look at currently. It's come down now to about 68, and it's gone up about 120, and it's coming down what could be, you know, at least 15-to-1, and that would explode the price of silver as well. So if people are talking roughly about 8,000 gold, if you're looking at even at a 15-to-1 ratio, you know, you're looking at about a $200 price in gold, in silver. And yet now you're getting people out there that think silver is worth $1,000 an ounce. Think about that. These sentiment has shifted the paradigm of the way we knew volatility, and short hedgers now are under alert. This kind of buy-in is wiping out hedge funds that are short hedge funds. It's amazing. There are 2 or 3 hedge funds, I believe, that have gone under. So I think the momentum that I'm seeing here is that it's moving into the silver market. While the other side of the silver market, on the short side, if you take a look at the Commitment of Traders report, so far, I believe the commercials, which indicate to be the central banks, the powers to be that are controlling the other side of the US dollar with gold, are at risk, in a major risk. They haven't been able to liquidate all their short positions that I believe are equivalent to over $35 billion. So silver now up a few dollars, you know, from just a few days ago, we were trading at 25. It's putting the short squeeze pressure on that short liquidity in the market, which is artificial. Those short positions are not covered by silver. And we're running into, and I believe this is what the money is smelling, is that we're running into a new lockdown and potentially different lockdowns, and the supply chain is being disrupted completely once again. That means that we might not be in a position to produce gold, silver. We might, have some issues with that. And so going back to the basic law of supply and demand, we're running out of inventories. Supplies are short in silver, gold. The premiums are beginning to increase tremendously in the cash market. If you want to buy silver, you got to pay a lot of premium for it, or in gold. Or the other choice is obviously to go to the futures markets and, take delivery through the futures markets. One thing I want to point out that I saw here just before this rally, and I pointed out to my trading room here that was pretty much on the 27th, I saw that the spot month in gold was trading at a premium to the back months. And to me, what this indicates is basically an inverted market. Whenever you see this inversion occur, it usually means that there is a shortage of supply because everybody wants to take delivery. There are still 59 contracts that were open to take delivery. And so we are seeing also people that are going into the futures to take delivery. But the problem is that it's putting in a squeeze on the COMEX. It's putting in a squeeze on the London exchange, the London Metals Exchange. And essentially, what we're going to find is that whatever physical they said they were carrying, it was highly leveraged. It was hypothecated in the very same way as we saw in 2008. They hypothecated mortgages, which caused the financial crisis pretty much. The difference is that the short side of the market are running scared because they can't cover their shorts, the massive shorts. The market is not coming down. If you notice, every time it comes down, new buying comes in at a higher level. Now we're looking at almost 1880 trading. It's not coming down, even though they're pounding the market, as you can see yesterday, or in pretty much 2 or 3 times. If we look back at the daily chart, you can almost see that when that manipulation takes place. Every time you see this big bars going back to August, pretty much is when we see massive short selling by central banks. And recently here on the 6th of January, we saw this attack on here. And so you can see here, every time we come down, a reversion occurs. We came down up to a 50% Fibonacci retracement, perfect technical indicator. If reversion occurred, kicked in the buy signals of the code, and the market came right down into this support Fibonacci trend line above the code, created a secondary high buy signal, reverted right back up. So the supply that's being offered here is being taken by strong hands, is what this means. And as you can see, the market is experiencing some supply above here, but the volatility is essentially bullish, buying into these corrections and looking to break out of this pattern of 1880, completing the target of 1900. And if we break out of this Fibonacci trend line resistance, you're looking at about 1917 on the 2-week on the weekly targets. And then of course we begin to move into some of the bigger pictures, which is the monthly and the annual targets. So coming back to the silver market, I think that the silver market is building an impressive base, moving ahead, you might say, of gold. But you can see here is entering into an area where we can see a little bit of supply come into the market. And so what's going to determine now what's underneath here, this market, is how the price functions through the supply. Which means that if we take out the highs of 2840, we're off pretty much to the races above 2733, which is where we are right now, trading above the sell to weekly, entering into the distribution area of supply on the daily that points to 2750 to 2840. Let's watch the trading of the market here for a little bit, as everything else seems to be settling in. So let's just watch the price action here a little bit. Testing 1 2. If you're having issues with your computer, you may want to reset your computer because we are live. We're watching the market. If you have any issues at all with the platform, just contact TikTok directly, and they should be able to help you. $18.64 is the monthly targets that we're looking at. 1864 so far. And that is a magical number that we seem to be trading right now. And so we got up to as high as 1878. The sell to level today was 1881. And we have entered a little bit of a choppy area as we trade between the sell one daily of 1863 and also the average price of 1864. So I think we're going to see for the rest of the period a bit of choppiness here. You know, and it would not surprise me to even see the market, come down and try to test the lower end of the daily average price of 1849. But the momentum obviously is pretty explosive here. So what I'm doing here is I'm using any of these corrections here in this market to add to my core long-term position. And take advantage of this, this highs as they are tested to provide some liquidity short term. Pretty much that's what trading is, and continue to build a long-term core position. When the price of the VCPMI trades into the red zones, it shifts the AI from actually taking new shorts positions to open, but not to close, and recommends to buy corrections only. As we see now the market beginning to challenge the upper end of this resistance channel, pretty much that points to that 1880, 1881 level, which is the sell to daily target. The momentum is to the upside, and you don't want to get in the way, basically, is what the algorithm is saying. So use these rallies to lock in profits only, but not necessarily to open new shorts, unless obviously you want to take the risk. It's up to you as the trader to you obviously apply this once you know how to drive it like a GPS, like I say, based on your profile. I take the path of least resistance. I want to trade the highest probabilities only, and allow for the market to identify those extremes above or below, ideally, short-term, intermediate, and long-term. A little bit of profit taken, obviously, from 1878. We're looking now at about a $20 drop from the highs that we made today. And, this again is the kind of volatility that we're facing, and you want to measure your risk based on your profile accordingly. They are trying to put pressure in the gold market as the silver market is holding like a solid rock. And so I think what we're looking at is the demand is solid in the silver market. The trading range that I believe we're looking at in the price of gold is basically the 1880 is the resistance that we're trying to accomplish. And if we close above it, then I think we're moving up towards that 1887, 1917 target. But again, you're looking at the price reaching this red levels here now, integrating the daily with the weekly and so on. And as we move higher, it's probably going to integrate also the monthly numbers. So, but you're looking at 1917. That's a pretty nice move, even just from where we are. And the pattern, even the daily pattern, is indicating the market has broken out of this a bit of a wedge here. That's a bearish wedge, which is breaking out of it is a bullish signal. The previous high here that we saw of 1960.250 on the 6th of January is pretty much what the challenge is, or the target on the big picture. Before we take off to the 2000, 2100 level. So this is the target that we want to focus on the big picture. Closing above here, again, 1874, 1880 would be the confirmation that we need. And in the meantime, we, pretty much the market is going to do what it's going to do. As the algorithm is saying here that, it's time a bit to kind of lock in some profits here, which I recommended in my private trading room to do. Use prudent money and risk management to do that, as we're beginning to see a little bit of softness in the market. Profit taking coming in. I don't think the up move is over yet, and so I am looking for a place to, get long again. For now, I think the market gave us the opportunity early this morning to lock in some profits here as we got up to about 1878, 79, which pretty much we did. So we want to see this revert back up again and close. Again, if it closes on the highs here, if it goes back into that 1870 here, it feels pretty strong. I don't want to go short against this momentum now that's broken out, as opposed to buy-in corrections. Continue to hold, your long core position, and congratulations if you have been watching me live streaming here and following pretty much the recommendations that we've been sharing here, produced by the VCPMI. If we get back above 1864, and that's going to be a monthly, bullish trend momentum again unfolding, which is against a short trigger that it would essentially convert the resistance of 1863 to support. Even though it tells you there, when day trading, from a day trading purposes, the probability at the 1863 sell one level mathematically is indicating about a 90% probability to sell, as opposed to a 10% probability to buy. So even though it can go up still another 10% or 5%, the sell to level is 95% probability. So it can still go from 63 to 81 into that 95% probability. And if it closes above 64, it's being supported by the monthly average price now, which converts the trend to a bullish trend momentum. And now, obviously, this price of 1863.64 becomes the support for the next price fractal. I think one of the recommendations that are being published out there is AG Majestic Silver, 1830 up 8% here today. It's just exploding. This stock is one of the stocks that is being recommended pretty much, as well as silver, as I said, going to $1,000 an ounce, which is just incredible. But you're getting, people commenting and making markets like this. I found this post fascinating here. Wall Street Bets pushing silver to $1,000 by Wall Street Bets. This is the website essentially that pushed the GameStop prices through the roof in the AMC and some of the stocks that literally exploded. Silver bullion market is one of the most manipulated on earth. Any short squeeze in silver paper shorts would be epic. We know bullion banks are manipulating gold and silver to cover real inflation. Both the industrial case and monetary case, debt printing has never been more favorable to the number one inflation hedge, silver. Inflation adjusted silver should be at $1,000 instead of $25. This is an amazing post that essentially is what pushed GameStop again to this incredible number. So, we're talking about the kind of market that is a small market that are, small traders. But if you put all those small traders together, you get a lot of volume. And I think the central banks now are in a little bit of a anxiety attack because they're beginning to see the transformation basically taking place that the small investor now has a chance to change the paradigm to his benefit. The small investor now, particularly through TikToker now and platforms like this that are offering you the tremendous opportunity to be able to trade these markets. If you're willing to take a risk, and you don't need now obviously that much money to do that. These are instruments that potentially can change your life. So it's a great opportunity to share this information with you, and I really hope that again all this information is of value to you at some point, regardless of the kind of trader that you are. I appreciate all the comments that you guys are making, and if you have any questions at all, you can please reach out to us. Reach out to TikToker. We have a complete brand new website, and I think we have some of the best leaders out there in the business. So I'm really proud and I'm honored to be part of this incredible platform. In the meantime, my friends, continue to come here, and I really hope that you become a better trader every day that you come here. You take care. I'll talk to you soon.
The risk of loss in trading commodity interests can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition, and considering whether to trade or to authorize someone else to trade for you. Past performance is not necessarily indicative of future results.
Steve Collegian here with John Najarian, folks. We're at Master Control here at TikToker. And Steven, this is an amazing platform you've built.